Okay. Thanks for the intro and the invite. I really appreciate it. So I'm probably the only one who flew out to California for this, so I had to dress a little bit less, formal than everybody else. Just want to start out introducing myself. I'm Buck Joffrey, and I am the host of Wealth Formula Podcast. And Wealth Formula Podcast is focused on alternative asset investing for high-paid professionals. So, first of all, alternative assets. What exactly are alternative assets anyway? Well, it's what we do, right? It's like real estate and stuff. So why do we call it alternative if it's been around before the New York Stock Exchange? Well, probably because everybody wants you to think it's something scary, right? When you think of alternative, what do you think? You think of maybe a mohawk or blue hair, or something like that. But it's just, stuff that's real. And so I focus on those types of things, primarily real estate, and also I focus on, again, higher paid professionals. And we'll get into that a little bit more. But a lot of it has to do with what Dave was talking about. This is the world really opens up once you have this tag called the accredited investor tag. Do you guys know what an accredited investor is? Accredited investor is not something you apply for. It's sort of like you either are or not. It's kind of like you're pregnant or not pregnant. You have, you make at least $200,000 a year, or at least 2 years, or you have a net worth of $1 million out of your personal residence, not including your personal residence, because of people in California and probably New York who suddenly became millionaires because of equity in the house. That is an accredited investor. Now, accredited investors have all sorts of opportunities that other people don't. And so, it's, if you're not one, it's still of value because, you'll be one someday and you'll have all these opportunities. But that's really what I focus on, is talking about opportunities and strategies that are available to them. So, in terms of what I'm going to talk about today, I'm going to do a little bit more about me so you kind of understand what I'm, where I'm coming from. Then I'm going to talk about wealth paradigms, from the simple to the more complex, to what I will call Wealth 2.0, Wealth Formula 2.0. And that's going to lead me to something that I'm a former surgeon, so I'm a math science geek, so I got to put a formula on something. So this mathematical formula that I think actually is pretty accurate. And then we're going to talk about real examples of how you can actually use this formula to create more wealth in a shorter period of time. So who am I? Again, board-certified surgeon. I don't practice anymore, but I identify more as an entrepreneur. I have started a few different companies in the healthcare field and some in the others, including a real estate syndication business similar to what some of these other guys are doing. Currently, I have about $250 million under real estate under management. And finally, I'm a podcaster, and that's kind of what I like to do. It's really what I enjoy doing because it's a great way for me to learn things and then teach things, and then also get to meet a lot of really interesting people. So, but I started out as a high-paid professional, right? So I was a surgeon. Believe it or not, I was a brain surgeon for a little while. So you're learning about money from a brain. So brain surgeon, I had neck surgeon, and then ultimately a plastic surgeon. Finished my residency, and guess what? After 34 years of education, I'm a little burned out. And so I was looking for other things. But you know what? Back then, I never thought about money. I know, you think about from hearing on the news about how doctors are trying to squeeze money out of things. And I never thought about that. And most of my colleagues did. We just thought about, recognition and power. But, seriously, those are the kinds of, we just didn't really think about money. We thought about being good doctors. We thought about having, high achievement that was recognized in society. So I left residency going, what am I going to do? I was going to be thinking about being a chairman somewhere throughout my life, things like that, but that wasn't going to happen because I wasn't that interested anymore. So I got married the day after residency, graduation, and I got married, and went on my honeymoon 2 days later. And then a week later, on our way back from Puerto Vallarta, I picked up a book. It was in this dingy Mexican airport in Puerto Vallarta, and it was like either 2 books with, you know, that looked like harlequin romance novels, and there was just this purple book sitting there. And this purple book was written by this guy. And so this is Robert Kiyosaki. If you guys know who he is, this is sent his birthday party a while ago, a couple of years ago. And Robert wrote this book that he's famous for called Rich Dad, Poor Dad. That's not the book I picked up. I picked up a book called The Cash Flow Quadrant. Anybody familiar with that book? Yeah. So that really, really changed my life. And it's just, you know, nothing in my life single-handedly has changed things the way that book did. And I'm fortunate not to be able to tell Robert about that and have him on my show. So what changed? You know, because it wasn't like suddenly I became, you know, I went out and bought a bunch of real estate and stuff. What I realized for the first time is that I didn't have to work for anyone, right? That was really the big aha moment. The idea of being an entrepreneur up to this point in my life had never occurred to me. Now you might be thinking, oh, why not, right? Well, think about it. I was a good student. I was a really good student. I was an A student. I got great scores on everything. Why in the world would I go outside of my comfort zone of getting very good grades and try to do something that I might fail at, right? So that's by the way, if you ever deal with doctors as clients, you have to get into that mindset, right? You have to get in the mindset, we're really good at certain things, and we're just kind of scared to do other things. So it never occurred to me. I thought about being, okay, I could be a doctor, I could be a lawyer, I could be this. But at the end of the day, all those things, what I didn't realize is I was working for somebody else. Now, that was one thing. The other thing was that there was this idea that I could and probably should invest my own money, and that never occurred to me either, because most people that I went to school with, you know, they're like, oh, who's your financial advisor? Who's this? And then you just buy a bunch of stocks, bonds, and mutual funds, have no clue what you've invested in, and then one day hope that you die with more money than you need. So finally, as I said before, it finally occurred to me that I was in complete control of my destiny, and ironically, that school was preventing me from actually thinking for myself. I mean, this was a big aha moment. So what did I do? I started a practice, and that became a couple of different practices, and then I started a couple of different types of businesses. I just wanted to get out of that, you know, cash flow quadrant left side. I wanted to not be W-2, not self-employed. I wanted to be a business owner, or I wanted to be an investor, or both of those. Because these businesses did really well, then I suddenly had money. And now I need to go back to that question, what do you do with money? Well, now, you know, my dad is a real estate guy, and I really didn't like what he did, though. We'd always have tenants calling. It was just terrible, and I kind of really looked down at it. But then I started thinking, well, gosh, what am I going to do with this money? And I started thinking about Kiyosaki and Kiyosaki's book again. I'm like, well, I guess I got to go buy real estate, right? And that's what I'm supposed to do. So that's what I did. And it worked, but it didn't seem to be quite as efficient as I thought it would be. And that's why I called this kind of sort of initial thinking of the Wealth 1.0 paradigm. And what do I mean by that? Well, Wealth 1.0 is, it's actually beyond what most people think. Because most people don't think of it at all, right? They just think, give your money to a financial advisor and never think about it. But when you read Kiyosaki's books, you go, wow. So all I have to do is buy cash flowing real estate until the streams of income are enough to support my lifestyle. Then I quit my job. It's easy. Why didn't anybody just tell me that? That's super easy. But here's the thing, is it's actually not that easy, because in my experience, and at this time, in my own businesses, I was making over $1 million a year. I was paying about $400,000 or $500,000 in taxes. So at a 10% cash on cash value, how much time, how much money would it take me to replace my income? About, well, gosh, 3.5 to not that hard, right? It's $10 million of real estate. That's a lot of real estate. So the Kiyosaki formula is not actually that easy when you're used to making a lot of money. But you know, the truth of the matter is, and having gotten to know Robert a little bit, it's not really what he does either. Because he wrote this for the masses. He wrote this so that, you know, people had a place to start. And it's a very safe way to think about it. So it's simple accounting. And in simple accounting, if you ask Robert what Rich Dad Poor Dad is, he says, it's an accounting book. It's an accounting book. By the way, it was written, believe it or not, he didn't think of this as a standalone book that would change the lives of millions as it did. He wrote it as a promotional piece for the Cash Flow board game. It just happened to become the #1 selling book of financial book of all time, which is pretty remarkable. So anyway, the bottom line is this idea that, you know, you can replace your income. If you're making a fair amount of money, it's not that easy to do if all you're doing is expecting 8 to 10% cash on cash. You got to figure out how else you can do it. And that's where this concept of Wealth 2.0 comes into play. So what is Wealth 2.0? Well, Wealth 2.0 addresses these questions like, how do you create wealth faster and how do you do it with less money, right? I mean, listen, again, $10 million of investments is a lot for a guy who's making $1 million and getting taxed on half of it. So once you figure out how to do it, you realize that this is the key to creating wealth and the secret of the wealthiest people in the world. And it may sound cheesy, but it is. It's not. This is what people do, and it's rinse and repeat. So I've studied them closely. And again, I'm going back to that, you know, geek in physics class. I borrowed from Newtonian physics and momentum. In this case, wealth is equal to mass times velocity times leverage. And in this case, what I'm saying is mass is simply the amount of money that you invest, right? You know, if you don't invest, it doesn't matter what kind of returns you get. Right? You're not going to make any money. And then velocity, which is something that is critically important. Critically important. And velocity is really how quickly your invested capital gets back into your pocket. So it's different from just yield, although it really is kind of yield. I'm really focused on how quickly I can get my initial capital back from something, still own it, and deploy it into something else. That's velocity. And then leverage, of course, using mortgages, other people's money. You guys, real estate people, totally know what that's all about. But there are other kinds of amplification strategies we're going to talk about as well. So let's talk about mass first. So in order to create wealth, of course, you must invest. You have to put money into it. Now, here's a problem that everybody runs into for the most part. You can only you can only invest so much money per year because you only make so much per year, and then you have to pay taxes. So one of the solutions to this, or one of the ways you mitigate this challenge, is to legally minimize your taxes, as Dave was talking about quite a bit. And another solution is to invest for equity. In other words, I don't, generally speaking, recommend investing in anything that is going to depreciate down to zero, right? I want something that even if it doesn't cash flow that much, at some point it's going to have greater value. It may depreciate on your accounting books, but it's got to appreciate in value. Otherwise, why you buy, you have to ask why you're buying it. And then the other concept here, which you're going to recognize, but I want to really emphasize, is a concept of recycling capital. That is the home run right there, is recycling capital. Because then you don't have to keep making money. You don't need 10 million to make $1 million. You don't need 5 million to make 500,000. Now you're going to use the same money over and over, redeploy it. It's a lot faster. So let's talk about minimizing taxes. I know Dave talked about this law a lot himself, but this is really important. Tom Wheelwright has been, a lot of you people have talked about today. He's actually my CPA as well. He's my CPA, and he's a brilliant guy. If you haven't read Tax-Free Wealth, please do. He's he's Kiyosaki CPA. He's just a brilliant guy, and he makes reading a book about taxes fun, which is pretty amazing. But he describes the tax law as nothing more than a series of incentives provided by the government. It's what it allows you to do. And, you know, what you get taxed on is only like a few pages of the tax code. All of the deductions make up the thousands of other pages, right? And they are basically what the government wants you to do. So a good example of that is oil and gas, and I know Dave talked about coal, which I'm less familiar with. But here's a great example here. You know, you put $50,000, $100,000 into oil and gas drilling, and you get probably about 100% of that write-off, even against W-2 income, which is great. The problem is that it's drilling, so that may be the last you see of it, and you may not get significant amounts of returns. That's been my experience. You know, people have different experiences, but I'm not a big oil and gas guy, just because I think the likelihood of returns is significantly less. But if you're a W-2 person, and if you invest, you know, amount to get you from one tax bracket to another, and then have a possibility of returns, it might be worth it. But I would, again, just warn, don't let the tax wag the tail, right? Just because it's a good tax investment doesn't mean it's a, you know, good investment, period. Now, real estate, you guys are real estate people. We all know real estate's a good investment, right? How many of you know what a cost segregation analysis is? Okay, so some people know it, and you know, in commercial property, this is a big deal. I think Dave talked about it a little bit as well. But just as a review, if you go back to your real estate broker's license or whatever you did, there's a difference between real property and chattel. So chattel is stuff that you can like pull off, shelves, cabinets, stuff like that. And what a cost segregation analysis does in a commercial asset, really, which is where it makes sense because they cost a little bit of money, is that an engineering study will literally pull the real property away from the chattel. And why is that important? Because the chattel can be depreciated over 5 years, not 27 and a half. Now, with the new Trump law, we take it to the next level, right? Because now we take that 5 years of chattel depreciation, which might be 30% of an acquisition price of a particular property, and we can squeeze it down into 1 year. And like Dave was showing, a negative $90,000 K1 from a $100,000 investment, that's how you get that. So it's pretty amazing. You know, the catch here, just to be clear, if you do this, you can use this against other passive investments, or as Dave said, if you're a real estate professional, you can use it against your active investments. Again, I have the real estate professional designation. I'm not a practicing surgeon. You haven't figured it out. Anyway, so in this situation, what you're doing is you're writing off a significant portion of your investment, up to 100%, and create both cash flow and equity. It's not depreciating down to zero. No, you're appreciating. You buy an appreciating asset. Okay, so here's an example of that, just in terms of cost, of how that affects cash flow too, because if you think about it in terms of the math, you may think, well gosh, I'm investing $100,000 in a private place into a syndication, and it's yielding 8 to 10% tax-free cash on cash, because generally, as we know, leveraged real estate is going to be tax-free income anyway. But if you're writing off that $90,000 off your AGI on other passive income, which in New York and New Jersey probably would be about like 40,000 or something, would be the tax equivalent of making 14 to 17% cash on cash. Now that is good, but with velocity, again, what's the goal, right? The velocity goal is to help you replace your income, and velocity is about how quickly you get your money back in your pocket. So if your goal is to replace $500,000 of active income with passive income, again, it's going to take you a million years, not really a million years, but, and $5 million to get to your goal. And so what's a more efficient way to accelerate the growth of your capital? Again, velocity is about recycling capital. So 10 or 15% cash on cash is good, pretty good. But what's even better is infinite returns. And what does infinite returns mean? It means that You own an asset, but none of your invested capital is in there anymore. I mean, what's better than that? Risk is off the table. Only growth opportunity, only capital gains, cash flow. And in the meantime, you're taking that same money and putting it somewhere else. And the beauty of it is that in commercial real estate, which is why I'm a commercial real estate guy, makes it very possible to achieve this. Why? Because you have the ability, like in most real estate, to borrow 70 to 80% of the money for the asset. And the other thing is the way that commercial real estate is valued. As you probably know, unless you're deep in the residential area, commercial real estate is really not valued by what someone thinks, right? They don't say, gosh, I really don't like the tiles here, I'm not going to pay that much. It's not what they do. It's about how much income, net operating income, is generated by the property. So if you drive up the income of the property, you're going to drive up the value of that property, right? Income, and then you drive up the value. Simple. It's like, it's not that, it's not brain surgery. So again, infinite returns. So an example of infinite returns is a cash out refi, or as I wrote here, cash out refi. But a cash out refi, you guys are all familiar with that, is an example because now you don't have any equity in the deal. You pull out invested equity and you maintain the same ownership, and you continue getting your cash flow, you continue having your ownership, etc. You have no equity in the deal, the returns are infinite, right? Yeah?
Do you mind explaining the first bullet point, what that means in a little more detail?
Well, I misspelled out in cash out. But the cash out refi is an example of creating infinite returns. So a cash out refi, so for example, say later on in this I talk about how with flippers, people who flip homes, the goal is ultimately you put money into this, you created so much value, and you're selling the house, but what if you just refied it and took out your initial capital, and now you own this house, but you don't have the initial of your capital outlay? There it is.
When you say refi, do you mean like get a loan on the property?
Yeah.
Right. Right. It's basically getting an appraisal, finding that the property is worth more than the bank will pay you more than you paid for it. So anyway, yeah, so you see this, and most of the time we get this kind of stuff from dumb luck. I mean, you hold a property for long enough, like in California back in the last 20 years, you become a millionaire without doing anything. And we talk about flipping houses, that's the way to do it. In commercial real estate, though, what the beauty of commercial real estate is, the way we value the property is mathematical, so we can drive up the value of the property by improvements that increase the income and decrease expenses. And so that's all we have to do. That's all we have to do. Now, it's actually in syndications with good operators who do value add things, multifamily. It's not uncommon for a full cash out refi for investors, in 5 years or so, and with a good value add process. So in other words, you put in $100,000, get it back in 5 years, and then recycle it into a new property, while in the first property that you bought, you maintain ownership, cash flow, and etc. And now you've taken that same 100 grand, you put it into something else, right? That's that whole idea of recycling capital. So now you're making money in 2 places at the same time with this same initial capital. It's like magic. So now, in Wealth 2.0, you need less mass because you recycle your money over and over into new investments. It's really, what this comes down to is how quickly you can do it, right? That's the missing variable. Now you can do this, you know you can do this, how quickly can you do this? And that you're going to make more money doing it. So I'm going to give you an example. So I'm a general partner with a group called Western Wealth Capital, and Janet LePage, who's our CEO, is her background is in computer science. So she sits there with these, big Excel data sheets, and all she looks at is math. Okay, we have entire groups who do different things in acquisitions, etc. But we're looking at, okay, if we put in washer dryers, how much can we get? We know from comps we get this and this. How much will it cost us? How much will it create in terms of value? Right? So we take that information, and then we had to figure out how do we go even faster. Because we don't wait 5 years to get our money back. Are you crazy? I don't wait 5 years. I do it quicker. So how do we do that? Well, most of our properties are Fannie Mae, Freddie Mac. There's significant properties, probably averaging about 25 to $40 million assets, up to 80 or $100 million assets. So we use something called a supplemental loan program from Freddie Mac. Now here's how it works. It's really cool, actually. So we get a loan, but we don't get it for, the loan covenants give us up to 100% loan to value. Now I know that sounds like, oh my gosh, he's doing an interest, or he's doing like no money down. That's not what we're doing. The covenant is for 100%. It means that we'll lend you up to 100%. We're only borrowing 72 to 73% like a typical acquisition. But what we do is at this point, as soon as we get that property, we sprint to make improvements from day one. We don't wait for people to even move out. We find out when they work and say, hey, would you like us to put a washer dryer in your place? Yeah, sure. And then a year later, their rent goes up. They don't notice that. But we make their places look beautiful while they live there. We don't wait. We don't have time to wait. We need to make some money here. So we put in washer dryers, change cabinets while they're at work, and they come back and they're like, holy cow, this place is fantastic. And that's why Dave Steele, one of my partners there, calls it the need for speed. So because of this loan that I talked about, which is 100% loan to value, we don't actually need to do the refinance. Right now, these are big loans. They're expensive to refi. All we have to do is get an appraisal. And the bank will give us money. They'll let us pull out equity. So we maintain our 72 to 73% leverage. We crank up the net operating income and go back to the bank and say, hey, do an appraisal. Yep, that's right. It's worth a lot more. Let us pull some of that capital off the table and give it back to our investors. And the way our model is, in this case, is we don't participate in any cash flow or capital gains until investors get 100% of their money back. Fannie, Freddie, and so it's a Freddie Mac supplemental loan. It's only a handful of operators that get access to this. And you'll see our numbers are kind of significant, so that's one of the reasons. But that's the beauty for investors, is like you say, oh, you got skin in the game? Well, hell, we're going to do all this work, and we're not going to get paid until you have every penny back in your pocket. Some incentive there, right? But, and you'll see from our results, you'll see why. So now, if you invested, so one of the other beauties of this is that you don't wait for 100% of your money either, right? So in 12 to 18 months, if you invested $100,000, now it might, our minimums can be as low, believe it or not, as $25,000, but 50,000, 100, let's use 100,000 because it's easy to do the math. In 12 to 18 months, we're going to try to get you at least $50,000 back in your pocket so that you can redeploy in 12 to 18 months. I mean, imagine the math on that, right? And then the rest of the money back in your pocket within 4 years. That's typically what we're shooting for. So once the investors get money out of their deal, they still maintain ownership and cash flow, and they keep recycling it in the same money in other deals over and over, collecting big bumps on dispositions every 3 to 5 years. So again, this is the group I'm with on the multifamily side. Western Wealth Capital, we've done 59 properties, nearly 12,000 units, $1 billion in purchases, $408 million in equity plays. So we have this thing that we call a Gold Star renovation.
Go back to that slide.
Uh-oh. How do I go back?
Can you back up?
How do I go back? Oh.
Thank you. There you go.
That one?
No.
Okay.
Yeah.
That's not the slide you want to take a picture of.
That's not the one we want?
No.
Here's the next one.
Okay. The Gold Star renovation, this is a recent property. Goal was basically to do a Gold Star renovation, which, it's like, we just have our little lingo for this, but it's essentially to make, a property that you see up there look like the one below it, right? So the other one's like was last done maybe in the 80s and 90s, and all of a sudden, boom, you see something that looks brand new, right? Did that to 200 units, $6,000 a pop to do that. Each renovation cost $6,000, but we added about $30,000 in value to the overall value of the property, resulting in a $6 million increase in the value of the property at sea. In addition, washers and dryers. If you're in multifamily real estate, you know that washer dryers are like gold, right? They're gold. The 200 units at $50 per month. At the 200 units, adding washer dryers, a $50 increase in per month. $2 million increase in the value of the property. It's math. We're driving in net operating income. Right? This isn't, gosh, I hope they like it more and pay me an extra 50 grand. This is math, right? And so we're buying stuff from us, other, private equity. We got people who are buying, we got REITs looking into what we're doing. And they'll pay stupid money, right? So we're taking stuff and we want huge returns and then let them get their 5 or 6%. This is that entire refi program in action, okay? Because it's one thing to say we're going to get you your money back, or half your money back in 12 to 18 months, and another to see what we've done. And this is 13 refinances you're seeing. The model used to be a big apartment flip, but now it's a refi model. If you look at what we have here with Edgewater, what that's showing you is that in 16 months, if you put $100,000 into this opportunity, in 16 months, you got a check for $71,000. Right? And similarly, if you go down to say for example, Lantana Gardens there, that's a second round of refinancing that's less than 3 years, you got 100% of your money back out of the deal. Okay? That one's probably worth a picture. Yeah, I'm just I'm just amazed at what we can do with this. And again, it's math. It's math. And that's what makes it beautiful. It's just, the same rinse and repeat thing. So, of course, we all want to get our money back, but really the goal here was to make money as well, right? So, I mean, listen, I'll give you 25% cash on your money. Yeah, I'll just give it to you for 4 years and we're done, right? You didn't catch that, right? Anybody can give you 25, 22% cash on cash. Depends how much money they're ultimately making. So what I'm talking about here is now you've got your money out of the deal. You're getting cash flow on a yearly basis, and then you get a big bump on the sell. On the sell side, it's going to be huge. Why? Because we're taking multi-million-dollar assets and selling them to people who want nice properties that they don't need to do anything for, and they just want coupon clippers, right? So they pay stupid money for that. So if you look at the kinds of returns that we've gotten, annualized returns for our investors, this is all in. I mean, some of them are obviously kind of insane, right? 141%. You get 50-some% annualized return. But this is all of the divestments. This is all of them. The lowest one, I think, is 11% annualized return. 11% annualized is not bad. That was a bad day for us. And this is, so our average with divestments is 30% annualized return. So the next thing I want to do is talk about leverage. So now we're not talking about multifamily anymore. I had to throw that in because I do a lot with a lot of multifamily, but I want to make sure that we cover some other educational things. Leverage we usually think of in terms of borrowing money so that we can use for leverage depreciation, right? To do the infinite returns things that we just did, to increase yield. But leverage is not just bank money. Leverage is really anything that levers the resources that you have. And what I mean by that is it just magnifies things. So we talk about tax deductions, how to increase mass, etc. But what if you could actually leverage your charitable giving? Say you make a bunch of money and you want to give away $100,000 and you do, but you get a $500,000 write-off. That's not a bad deal, right?
And how do you do that?
I'm going to tell you. So obviously, you know, Dave and I are both people who think a lot about taxes. And really, this one you got to be a little careful with. There's a lot of these things that are perfectly legal, but you have to be really careful with. You have to know the right people, right operators, etc. And I'm happy to share that with you. The conservation easements are a really interesting thing. So here's how it works. So you have a builder who wants to develop land. So he may have an opportunity to forego building and elect to give up those rights of building on the land altogether in perpetuity. And the reason for that is to preserve the land for conservation purposes. So you might think, who does that? Sounds like Ted Turner. Donald Trump has a lot of golf courses. I wonder if that has something to do with this. Well, so that foregoing of building rights may actually trigger the ability to take a tax deduction on the land, which in and of itself is great, but the amount of that deduction is made by the valuation, which includes in part the value of the property that would have been built. Right? So now you've got, okay, well, this land paid $100,000 for it, but the thing I would have built on it was like $500,000. I've got architectural drawings to show it, so I'll take that deduction. That's how it works. But these would tend to be on very, very significant properties. Several, you know, $40, $50, $100 million assets. So it's a complex process that has to be done, but then you get these valuations that can be extremely beneficial, as I just showed you, to taxpayers with all income types, including W-2 income. And it typically will allow you to write up, well, the tax law allows you to write off up to 50% of your AGI this way. Why? Because it's a charitable giving thing. So, of course, not all of us have got $100 million sitting around that we want a $100 million piece of land to give away. So what we can do is we can go back to that concept of syndication, right? Where we can put in small amounts of money and share in the benefits. So you can do syndicated conservation easements that allow for investors. Again, you got to be accredited for this stuff. And again, remember, accredited like pregnant. So the example here would be 40%. For example, say you've got 40% tax. You're in the 40% tax bracket. I don't even know what that is. I don't really pay taxes anymore. But the bracket. Real estate professional. MD. So say your AGI is $400,000, right? So with if you're paying 40% taxes, you're going to pay $160,000 taxes, right? So if you get a 5x valuation, you could deduct on a conservation easement and invest $40,000 in it. Now you 40,000 times 5, you take a deduction of $200,000. So now your API is down to $200,000, and for simple math, now you're paying. Well, you lowered your bracket too. I'm not making it that confusing, but now if you were paying 40% on that, it would be $80,000 plus the $40,000 investment that you made. Now you'd be paying $120,000 instead of $160,000. Now in reality, the savings are a lot more significant than that because you're actually going down to the next bracket, etc. It gets insane. Jerry here? Jerry's in my investor group. Jerry, how much, percentage-wise, how much do you think have you been able to save on these things?
About 52% of my W-2 income.
52% of his W-2 income.
Good for you, Jerry. Go, Jerry.
Yeah. So Jerry's a W-2 guy. There's not a whole lot of things you can do for this. If you do this, you got to do it right, though. It's critically important. We talked about that. You got to have the right operators. You have to have people. Because you know what? Guess what? The IRS hates these things. And you're going to see articles and forums. You don't see articles everywhere about this stuff. And it's because when you have a law like this, there's a lot of groups that will be abusive. You just have to make sure that you're doing everything right. And the reality is, I brought up Ted Turner and Donald Trump because they're the two largest conservation easement holders in the United States. So, it ain't going anywhere. It might go away, but right now it's perfectly legal. And I've used this, I've used this before on multiple occasions. And I've even been audited, not because of an easement, but because anytime you make a decent amount of money, you're going to get audited. What do? They look at the K1, they'll like shake their head and they say, what? Okay, that's about all I can do. Anyway, again, you've got to find a legitimate operator. Don't be impressed by overinflated valuations. That's what's going to get you in trouble. If you're interested in this kind of thing, you're a credit investor, and you can ask me, you can join Investor Club. Wealthformula.com, by the way, is our website. If you want to go to wealthformula.com and you're a credit investor and you want to see all this kind of stuff that we do, feel free to sign up for that. So anyway, in conclusion, this is the idea that it talked about with this Wealth 2.0. And I think of it as a significant upgrade over Wealth 1.0, right? You know, cash flow your way into your millions and exceed how much income you make. It's not that easy. But the things that we're talking about here make things a lot easier. It's all about the math, knowing the right people and the operators. That's where our investor club, I think, comes in, right, Jerry? Go to wealthformula.com. Listen to the podcast. If you're a podcast listener, we talk about this stuff. If this is interesting to you, you'd like our podcast, my podcast, iTunes, Stitcher, YouTube. I also have a book that really is more of a Wealth 1.0 book called 7 Secrets of Eternal Wealth, which is an Amazon bestseller. But you can download it. You just text 44222 and put Wealth Formula. You can get a copy of that. Again, that's more basic stuff. I wrote that, for people who are just sort of stuck in the really old-fashioned mentality of letting people do all their, just handing their money over to others. Anyway, that is it for me. I think that's, yep. Thank you. Questions?
Are there fees for the money you're investing?
In what?
So when you're investing in a syndication,
Yeah.
what kind of fees are
Yeah.
there on every dollar you invest?
Yeah. So the way it typically works in a syndication, multifamily syndication, is so first of all of the returns I showed you were netted fees. So in other words, 30% average that we get a Western Wealth right now, that's what people are getting, 30% annualized return. So yeah, there's some upfront fees, but the major part of it, I think, relates to the model. Is that most of the time you see in a syndication there's a split, right? There might be like a 70% of income goes, or 70% equity goes to the investors, 30% to the general partner, and then there's like an 8% preferred rate to the investor. So you may have 70, 30, 80% prep. That's pretty standard. In the Western Wealth model, it's a little different. There's no prep. Basically, it's 100% prep. You have to get all your money back before there's sharing in any cash flow and capital gains. Does that make sense? So, yeah, there is fees after you get your money back. There's a split, an equity split. But it doesn't kick in until you've got all your money back.
So you're saying that in your model, just different than the other models, your investors get all their money back, and then once they start making a quote unquote profit, there's a split.
There's a split.
Like we split with the broker.
Well, I guess you could think of it that we generally think of it less of it as a fee split because it's not a fixed fee. It's just like the ownership once you get your money back, then the general partner in our model actually participates in equity. They become part of an owner of that property for doing the work. That make sense?
How much part of the ownership here?
Pardon me?
How much of the ownership here?
So the ownership after capital return is 65-35. But again, that is, with the numbers you saw are net of fees.
And then fees, and then,
In other words, the numbers I showed you, which 30% annualized return, means that our investors are on average doubling their money every 3 years.
right. And that's their piece. of
That's
what
their
they're
piece.
getting.
That's what they're actually getting. They're not splitting.
What are, yours is seemingly very high, so what are the other
It's different.
ones?
So it depends how you look at high, okay? Let's look at a model where it's 80-20, 8% prep. So now, anything over 8% return from day one, before you've gotten your money back in your pocket, there's participation from the general partner. There's no participation on our side until you have all your money back. And so that's the big difference, right? So you might be able to get, 80-20 and 8% prep, and then after that 8%, if there's money on top of that, it gets split, right? In our case, you don't have that. There's really no, the only incentive there is on the general partnership side is to move things along as soon as and quickly as possible because we're not getting paid.
And then your split on the back end is maybe a little higher?
It's a little bit higher because of
You're
that.
taking more risk on the front end?
That's right. That's right.
Okay.
But again, I think the way to think about it, and we talk about this kind of stuff in our investor group all the time, is that if you look, and I've structured things differently, I've been invested in things differently, you have to look at the business model as a whole. And what I like to do as an investor is to try to figure out what is going to drive the operator to perform, right?
The security that you're building, when you invest in it, you're investing in the fund or in
Individual assets.
individual assets? So do you have one investment vehicle that is an investment in multiple assets?
No.
Or
No, what we do is these are typically limited, for accredited investors in our group, which again you can join for accredited. But what we do is we have webinars on offerings on a regular basis. So, for example, we just finished up. Well, this is another one. This is another operator that I did a partnership with. We finished up one. We have 2 more deals coming through the pipeline next month. One in Dallas, one in Houston, and so we'll have individual webinars on those. Yeah.
On average, what's the minimum amount that the investors?
Yeah. So the minimum, it depends on the size of the asset. We have frequently been using $25,000, which is a massive pain from an accounting standpoint. But the reason we can do that is we only do cash flow distributions once a year. And so, again, this is not, I think you get cash flow, but I wouldn't think of this as a cash flow model. This is an equity building model, right? This is a wealth building model. And one of the reasons that I like it personally, again, is, I don't know how many multiple, mid 6-figure people I know are buying single-family homes and making $200 a month on that house, and it just doesn't move the dial. Doubling your money every 3 years really moves the dial, especially because of all the cash of the tax benefits too. But yeah, in the bigger assets, for example, we took down a $80 million asset in Dallas about a month ago, and in that case, I think we had to push up to like 50 or 75, close to 75 or something. But we try to keep it low. We have investors. We have some. The founder of BlackBerry, for example, is one of the large investors. Did $100 million with Western Wealth Capital last year. But they typically kind of take the whole deal. And that situation, but we're really focused on retail sort of mom and pop investors. So really it's the opportunity to participate in these institutional type investments with as little as $25,000, which I think is really unique.
There's a question in the back there.
I just had a quick question here. So I invest in a lot of syndications, and one of the things I always look for is prefs concern me sometimes, and my biggest thing is over the past number of years, obviously most deals did well. You know, that's no secret to a lot of people. But my concern is if the market does go down a little bit, rents fall, pro formas don't hit, what happens if, you know, an investor asks you, if you're offering me an 8% pref and year one's 4%, year two's 4%, now you've really started to fall behind, would that cause you to sell at an inopportune time? That's the question that I typically would have for a sponsor in that situation.
Yeah, you know, and it also depends what they mean by pref, right? And what you're talking about is basically a guarantee where they're literally borrowing capital from you effectively for 8%, and then they have to write checks if they don't do it. Yeah, that's right. I mean, you know, there's some risk in that. There is significant risk. I personally think that the model that I'm talking about, and I'm biased, obviously, because I started out as an investor, became a general partner with these guys, but I like the fact that the goal is to get your money back, and that does two things, right? One thing is it takes risk off the table, right? I mean, even if a property is lost, you know, it's a non-recourse loan. If a property is lost but you've got all your money back out of it, well, damn, that sucks, right? But you don't lose your money. So the goal is to drive back the money as soon as possible, to de-risk it. And I think the other problem with prefs is that they may seem like they're favorable for investors, and they kind of can be, but you know, the thing about it is that you see it a number of times when people talk about prefs, they're saying the first 8% or the first 7% of cash flow that comes off goes to you. Well, what if there's only 4% cash flow?
Right.
Well, that's what you're getting, right? And the second you get over 7 or 8%, then you're splitting it. So for me as an investor, I like to get my money back and then you can play model.
Sure. And do you, have you been placing, I'm just curious what your opinion is right now at this point in the cycle on bridge debt to make deals work?
I'm sorry, for specific.
Like bridge debt, because I'm on a lot of syndicators lists, and I've been getting sent a lot of deals recently, and I feel like over the past year I've seen a lot of deals that they're placing bridge debt on the property, and I think that's the only reason they're trying to make it look like the deal works. But you know, my concern is what happens if we're in a lending environment 2 years down the road and the loan comes due and you know they're kind of stuck with it.
Yeah, we don't use it. You know, in fact, our raises are CapEx heavy. So if you go back, if you remember that slide where I showed you, it's like almost probably in terms of acquisition prices, we're raising almost half the capital because most of the almost none of the CapEx is amortized. So we're taking that stuff up front, so we don't really need to bridge that. And then our goal is just to, you know, to move these properties as soon as possible. So, you know, so we've never had to deal with it.
Sure. Thank you.
Those kinds of things, honestly, they make me a little nervous, as in part what you said in this environment. I think our goal, again, is, you know, so one of the other questions that comes up frequently is, okay, well, what if there's a significant decompression of cap rates, which is a good question. And the answer in that situation is, we're going to keep doing what we do. We're going to raise net operating income. Now, it doesn't do the general partner any good to sell that property if there's not a good market for it. So then we just hold it in cash flow. But we don't need to necessarily think about cap rates that much because all we're really trying to do is just drive income into this thing. Enough income so that somebody's going to either want to pay a lot of money for it or we're going to get cash flow.
Thank you.
Yep. Any other questions?
Are you writing another book?
I'll probably do the 2.0 at some point because the 1.0 is kind of boring. But I think people like it. So. Anything else? Nope.